It's the middle of March 2025 and all markets, stocks and crypto are down. So macroeconomically, everything is down. And today I wanted to talk about how to utilize these down markets and actually use them in your favor through tax loss harvesting. So it's a very powerful tool. A lot of people are using it. And essentially all it is strategically taking losses so that you can reduce other gains that you might have. And this ultimately results in a lower tax bill. And if you don't know who we are, my name is Justin. I'm the head CPA at CountonsheepYT. We are a crypto accounting firm focusing solely on crypto tax preparation and planning, as well as digital asset accounting. And we are helping investors everywhere optimize their taxes and make sure they're staying compliant. So stay tuned. So I've written out a scenario behind me here on some buying and selling that someone might have done. Obviously, I've rounded the numbers to make it easy to follow. And so imagine on November 5th, 2024, someone bought some Bitcoin. They bought one Bitcoin exactly at a price of $70,000. So overall, the total value is $70,000. Now, as we know, when you're buying crypto with cash, there's no gain or loss on the purchase. Similarly, on December 16th, 2024, at the 2024 ETH high, someone bought 18 ETH for 4,000 in ETH. So purchasing, pretty high. Overall, they spent $72,000 on that ETH. And again, there is no gain or loss on the purchase, assuming they are using fiat. Now, in 2025, Bitcoin really ran up, up to January 20. So they sold at the height in 2025 of 110,000 per Bitcoin. So they took that initial Bitcoin they bought for 70, and then they turn around and sell it for $110,000, banking a $40,000 capital gain. So the question here is, we know the markets are down, whether it's stocks, whether it's crypto, whatever, almost everything is down. What can we do to help reduce and mitigate this capital gain? So what it comes down to is you have to look at the facts, right? We can always speculate about what's going to happen in the future. Maybe prices are going to go back up. Maybe they'll keep going down. Who knows? Or maybe they'll trade sideways. But from a tax perspective, from a tax planning perspective, it's always a good idea to look at the facts and what we know right now. So what I'm going to do is I'm going to write out a scenario, shortly here, and show you what would happen if they decided to potentially sell some of that ETH, which is certainly trading at prices lower than $4,000. Stay tuned. Okay, so it is currently March 18th, 2025, and ETH is currently trading at 1,900 bucks, give or take. So let's assume that this person decided to tax loss harvest. So what I mean by that is they sold their 18 ETH that they had initially bought when it's at a price of $1,900. So it's gone down significantly from their entry point at 4,000 in ETH. So in total, they collect proceeds of $34,200, banking this $37,000 or around $38,000 loss. So what this means is overall, this $40,000 capital gain is going to be reduced by this ETH. So they're going to end with a net 2,200 gain. Okay, so they effectively did lose money on that ETH trade. But the question is they might be thinking, oh, it's going to go back up. It's going to go back up in value, so I'm just going to hold it. And that's good and fair to think about. However, we know for a fact if we exited this position and sold it for this price, we are going to bank that loss. So we can actually use it right now against our capital gains. If it goes up, great. If it doesn't go up, then we're just sitting on this loss. So what someone could potentially do is they sell out of their ETH. They maybe trade for a few other altcoins, or subsequently they decide they would rather get back into ETH. They can actually buy back that 18 ETH without needing to necessarily worry about the 30-day wash sale rule, because that applies specifically to securities and crypto is property. So you do need to be cognizant of the economic substance doctrine, which essentially states that you can't really do something specifically for the purposes of avoiding tax. So it's important that every decision is independent. If you're selling this ETH, it's because ETH is tanking and you don't want to lose any more money if it goes down. If you subsequently re-enter the position, that's a new decision that you're making, in regards to whether you think it's going to go up in value or go down. So that's just one thing to keep in mind. But as of now, that 30-day wash sale rule does not explicitly apply to crypto. So you don't necessarily need to wait 30 full days before you can enter back into that position. So as we can see here, Once they sell this ETH, their $40,000 net capital gain is going to be reduced to just $2,200. And again, this is playing on the idea that what we know right now is that ETH is here. You know, it's down. They're sitting on an unrealized loss of $38,000. So if they don't sell, you know, and the end of the year flips, they're going to have a $40,000 capital gain. If they decided to sell this position, they could realize that loss, reducing that capital gain, and ultimately reducing their tax bill. So it's a very important strategy. This is something that everyone, you know, that's using a tax planner is always thinking about. Harvesting losses to offset current year gains. It's very important that you consider it yourself. Otherwise, you might be, you know, caught paying a bunch of tax when you have positions that have unrealized losses on them. Now, to add on to this, I wanted to talk specifically about what I call a tax loss harvesting gold mine, and that is dead meme coins and NFTs. So we all know the Solana casino, there's a lot of rug pulls, a lot of meme coins that ultimately just die out, go to zero. And then similarly with NFTs back in 2021, there was a huge craze going on. A lot of people were buying and swapping NFTs, but ultimately a lot of them, you know, went to zero essentially. So these are tax loss harvesting gold mines. All the time with clients that we have coming through our doors, we see them sitting on these NFTs or dead meme coins, and they think to themselves, well, it's gone to zero, what's the point? Why even try to trade it or dispose of it? And the point is exactly this. You're sitting on an unrealized capital loss that if you sold or disposed of that position, you would be able to realize that loss and then reduce your current year gains. So if you have NFTs that have gone down in value or meme coins that have potentially gone to zero or substantially decreased, these are a gold mine to harvest those losses and use those losses in your favor to, you know, capitalize on those losses and use those against your capital gains. And then one more thing to add on to that is it's not just crypto. So if you have capital gains in stock or real estate or any other capital gain, you can actually use your crypto losses to offset those capital gains. So it's, you know, you don't need to just stay within crypto. You can actually go over and use those losses against other, other capital gains. So it's very important to always consider this. I hate seeing clients come to us with these huge unrealized losses on various different tokens and NFTs and whatnot. So this is like one of the easiest ways we can help them save money is by letting them know they could get rid of those positions and then harvest those losses. And don't forget to like and subscribe and follow our X for the latest updates. And if you would like help with tax planning and tax loss harvesting or just generic crypto tax preparation, make sure to book a call below with either myself or one of the CPAs on our team, and we would be happy to help you. We walk through everything with you, get to know your portfolio, get to see what's unique to you, and then help develop a strategy so that you can help maximize your savings. So do that below and see you next time.